All right, folks, I'm going to start. Good morning to you all in these difficult times, especially for manufacturers of below-the-waist formal wear. I'm also struggling this morning a little with how Zoom makes one's shirts look unironed. I've been asked to begin with a couple of formal notices. If you have any questions that you'd like to ask, please use the Q&A format, which I think you can bring up by scrolling your cursor over the screen, and I'll take questions at the end. We're very, very grateful at Devro to all of you for joining. We're also grateful to you for your helpful feedback on past webinars. Please feedback on this one. I'm going to aim to talk for about half an hour about NCL and Smith & Williamson and HMRC and the Court of Appeal. And it's a rather odd case, this one. It's simultaneously absolutely fundamental to the operation of our tax system, and also, arguably at least, completely irrelevant in real life. It's a bit like the sort of wealth tax or universal basic income. What was the case about? And here I'm reminded of the words of Chris Stone, who told me, use PowerPoint, Jolyon. So I'm going to share my screen. It's not quite PowerPoint, but almost. Now, what you all ought to be able to see is a Word document. And I'm just going to briefly describe to you the group structure and the transaction. It'll take a couple of minutes. It'll just make it much, much easier for you to follow the rest. So nothing particularly complicated about the structure. You had a listed holding company, and then a group employer company. In fact, you had two group employer companies, it doesn't really matter, who employed almost all of the staff in the group and supplied the services of those employees to other trading companies, operating companies in the group, which I've called illustratively Trading Co. 1 and Trading Co. 2. The staff employed by Group Employer Co. were remunerated through a combination of cash, but also shares that were granted by the EBT trustees over shares in the listed holdco. So the taxpayer in the Court of Appeal decision was the group employer company. And as you can see, I've just sort of set out here the facts with which the Court of Appeal was confronted. It employed staff, paid them illustratively cash of 90, and the staff were remunerated in relation to the remainder by share options worth 10 in the listed holding company. The group employer company actually paid its parent 10 for the options, and it charged the other group companies, the trading companies in my example, the 100 plus a markup of 10. So I've just illustrated that as 55 each. And so in consequence, it's employing staff, it's paying them 90, it's paying 10 to listed holdco for the share options. It's charging their services out at 110 in aggregate. And so it's making a margin of 10 at the end. And then the accounting on the grant of the share options, one needs to understand as well. So if you look at the taxpayer, Group Employer Co., when the share option is granted, it credits capital of 10, and I'll talk about that in just a second, and it debits expenses of staff costs of 10. And the reason that it credits capital of 10 is a funny accounting reason, notwithstanding that Group Employer Co is going to recognise a liability to listed holdco in respect of the value of the share options, you had an initial debit of expenses star costs, but the contra entry was credit capital of 10. And then, as we're no longer allowed to say a scintilla temporis later, you debited that capital credit, so you reverse that out, and instead you credited intercompany loan. So the real transaction, if one ignores that account fiction for a second, is you're recognizing expenses of 10, the cost of paying your staff on the one hand, and on the other hand, you're crediting your loan obligation to the listed holding company, which is obliged to pay for the shares. In as much as it matters, the listed holding company has more or less the same entries, but in reverse. Initially, it recognises an investment in its subsid and credits, diminishes the share option asset that it owns, and then that transaction is reversed out. It credits the investment of 10 and debits the intercompany loan account. So the netted off transaction for the listed holding company is that its share option asset is diminished by 10, but it has the entitlement to recover a loan from its subsid. So more or less exactly what you'd expect. And the case is about the debit that I've highlighted in yellow. So the case is about IFRS 2. The IFRS 2 says that if you're measuring your profits, you have to take into account the inputs that you have consumed in generating those profits. The services of your employees are such an input, so you need to take those services into account. Very hard to value that proportion of the services of your employees as are attributable to the grant of the share options. So what instead IFRS 2 says you have to do is use the value of the option as a proxy for the value of the services that you've received from the employees. And so recognizing that you've consumed their services, you take a debit in the amount of the value of the options in calculating your accounting profits. So that's the sort of that's the logic of the International Financial Reporting Standard with which the first tier tribunal and then the upper tribunal and Court of Appeal were confronted. And in a sense, it's all kind of obvious, really. If you assume that I'm a buyer and a seller of widgets, and I give share options for those widgets rather than buying them with cash, if I'm calculating my profits, I can't sensibly ignore that I have had to give something for those widgets. I can't just ignore the fact that the widgets were worth something in calculating my taxable profits. And that's actually not a bad analogy for this case. If I just scroll up again, you can see here that the taxpayers were buyers and sellers of the services of employees. And it would be quite bizarre to exclude part of their acquisition costs in the calculation of their profits. It would be bizarre to pretend that the employees whose services they were selling were not remunerated in part by the grant of share options. So looked at in that way, the accounting treatment is all pretty unsurprising. But in another sense, it's quite odd because in this case, the taxpayers, I should say, did pay for the grant of the share options, but HMRC stressed the point in submissions below and all the way up to the Court of Appeal. HMRC stressed it didn't actually matter that the group employer companies, the taxpayers, paid for the share options because they would have got the debit in yellow anyway. So it can't matter as a matter of principle, and HMRC is right to say this, it can't matter as a matter of principle whether or not on these facts you have to pay for the share options. This is it's not formally a lead case, but informally there are a number of other much higher value cases waiting in the wings. And in many of those cases, the taxpayer appellant did not actually pay for the grant of the share options. So those taxpayers are in a world in which they are seeking a debit, the debit in yellow, without any outflow of resources. So the result is that you have a situation where you can generate a debit in your P&L despite the fact that there is no outflow of your resources. You don't need to pay cash. You don't need to do anything. I mean, strictly speaking, the grant of share options is a transaction inter se the holders of your equity and the grantees of the options. You don't do anything at all, and yet your profits are, for tax purposes, reduced. Indeed, you don't even need to grant shares because the debit which arises on the grant of the share options and in subsequent periods until those share options vest arises irrespective of whether that option is ever exercised, whether shares actually vest pursuant to that option. And if you want to put the matter really starkly, I suppose you describe it in this way. If I swap a share option worth 100 for a widget, and I then sell that widget for 100, the taxpayer company, will have generated cash of 100. I'll have 100 of cash in my hands, but I won't have any tax liability on that 100. So if you put the matter really starkly, I suppose you can see why the revenue thought it was an interesting transaction to litigate. Not that it matters, but there was no suggestion here that these taxpayers were motivated by the desire to obtain, as we politely describe it, an efficient, a tax-efficient outcome. So those are the sort of interesting conceptual issues that the case raises. What were the legal arguments? Well, HMRC raised fundamentally 5 arguments, any one of which would have sufficed for their purposes. And the first argument they raised was they said, well, no expenses were incurred here. So Section 48 of the Corporation Tax Act says that in calculating the profits of a trade, no deduction is allowed for expenses not incurred wholly and exclusively for the purpose of the trade. They said no expenses were incurred because no cash passed. The revenue said this wasn't like a provision. They accept that if there is a provision, expenditure is incurred, because you only take a provision where you expect that cash or other resources will pass. And here, as was common ground, at least if one considers the yellow debit in isolation, there is no outflow of resources. Moot point, by the way, whether it's more interesting to look at me or the slide. So I'm dividing my time strictly in half. That was the first argument that the revenue raised. And the Court of Appeals said, well, that argument's just not available to you on the law. So they note that Section 48 of the Act provides, firstly, in the Corporation Tax Act, in the context of the calculation of profits of a trade, references to receipts and expenses are to any items brought into account as credits or debits in calculating your profits. And subsection 2, which is a sort of for the avoidance of doubt type provision, goes on to say it follows that references in that context to receipts or expenses don't imply that an amount has actually been received or paid. And what the Court of Appeal said was, well, these provisions are making it clear that it doesn't matter whether or not cash or other resources pass. What matters is the accounting treatment, and what Section 48 does, said the Court of Appeal, is prioritise generally accepted accounting principles. Fundamentally, the revenues argument, the main argument really, was one that sought to introduce a sort of judicial rule alongside both the accounting treatment and the specific exclusion that you'll all remember. You remember that the architecture of the code says, well, your taxable profits are whatever GAAP says, subject to any adjustment required or authorized by law. And the Court of Appeal held that fundamentally HMRC's argument was an attempt to introduce into that intricate statutory architecture a judge-made rule. So that was the revenue's first and main argument. The second argument the revenue ran was a paragraph in the upper tribunal decision in Ingenious. And many of you will know the Ingenious case, a sort of battery of the great and the good of the specialist tax bar argued about, well, in truth, they argued about most things in the world. But one of the things they argued about was whether the word incurred meant that there needed to be an outflow of resources. And the upper tribunal in Ingenious concluded that it did require that there need to be an outflow of resources. And so the revenue said, well, on its face, there is a conflict between Ingenious and Smith and Williamson, two upper tribunal decisions. And frankly, as I said, the Court of Appeal, the revenue are right to say that there is a conflict. But what I observed to the Court of Appeal was that I basically said that I thought the upper tribunal in Ingenious had decided the matter on the basis of the arguments put before them. If you read the upper tribunal decision pretty carefully, you can see that they say it, not quite in terms, but they say that more or less several times. And certainly it seems to me, at least, that the Ingenious decision relied very heavily on what the word incurred means in a capital allowances context. But the burden that the word incurred means in a capital allowances context is that the burden given to that word is a very different burden to the burden that the word bears in an accounting-led regime. In the Capital Allowances Act, incurred does an awful lot of work, but all of that work here is given to the expert accounting, the proper accounting treatment. The Court of Appeal agreed with that argument. They basically say that they are not sure that the Capital Allowances Act jurisprudence on what incurred means is hugely pertinent to the accounting-led regime in the Corporation Tax Act. And if you really read Ingenious quite carefully, I think even the upper tribunal thought that those arguments, the arguments that were put before it by counsel in Ingenious were wrong. They say we decide the issue on the basis of the arguments put before us, but there are a couple of indications in Ingenious that they don't think either set of counsel argued the matter properly. But also fair to say that I have a sort of hashtag tax crush on Judge Falk, who was one of the judges who heard Ingenious, and that may alter my perception of that judgment. Anyway, what we now have is the Court of Appeal's reconciliation of those two cases, and we know that it is now saying that there doesn't need to be an outflow of resources for expenditure to be incurred. The next argument HMRC ran was about whether the debits were incurred wholly and exclusively for the purposes of the option. And you'll recall from Malalieu and all that, that this is really about the subjective purpose of the taxpayer. And HMRC said here that because the debits arose in respect of the grant of options by the EBT trustees, rather than anything done by the taxpayer companies, it followed that the taxpayer companies couldn't have any purpose at all, let alone a purpose that was wholly and exclusively a business purpose. And that argument is one of those arguments that has appeal to you when you're starting off life as a lawyer. But when you get more grey-haired, you basically say, well, get real. And that's what the Court of Appeal said here. They observe that the purpose of recording an accounting debit is always to comply with your statutory obligation to keep proper accounts. But you have to lift your head up from your parchment accounting ledger to look at the real world. And if you look at the real world here, these accounting debits were in respect of the remuneration of employees and were plainly on revenue account and plainly for a proper revenue purpose, that revenue purpose being the generation of taxable profits in the business of buying and selling the services of employees, buying from employees, selling to other group companies. The fourth point that the revenue ran was that the debits were capital in nature, and I found that perhaps the most surprising contention of all. And the basis upon which the revenue said that the debits were capital in nature was because they were the contra entry to the investment by the parent co in the subsidy. Remember I said that there was an investment that you immediately reversed out with an intercompany loan. And to my surprise, in the Court of Appeal, the revenue ran this point really quite hard. They said, look, it's all about the contra entry. But the Court of Appeal said, unsurprisingly, don't be silly. You don't look at the contra entry, you look at the actual debit, which was for employee services and on revenue account. I mean, that's obvious, isn't it? If I buy stock, I get a debit, whether I pay cash for that stock or I grant shares for it. The nature of the remuneration the nature of the compensation that I give for an expense that I incur on revenue account doesn't change the quality of that debit. It doesn't change the quality of that expenditure from revenue expenditure to capital expenditure. And then there was also a dispute finally about section 1290, which is fact specific. I'm not going to address it because, as I say, it's specific to the facts of that case. I didn't think that the point was as difficult as the Court of Appeal seems to have found it. But ultimately it doesn't matter because the Court of Appeal decided it in my favour anyway. Two final points before I take questions. The first point is this: the tax deduction on the grant of share options has been removed by legislation, but the case is still important, firstly, for the many other taxpayers who are waiting in the wings, wanting to know for their own purposes what the answer is. And second, because of arrangements where people provide services to taxpayers in return for an equity share. And reasonable to anticipate that that sort of transaction might become more common in a world in which companies are strapped for cash. They might remunerate remunerate their suppliers in terms of grants of equity rather than cash. And then the final point I wanted to pick up before I take the various questions that I can see on the bottom of my screen is whether HMRC are likely to seek permission to appeal. I think HMRC are likely to ask the Supreme Court for permission to appeal. The case conceptually is important. It does go right to the heart of the relationship between accounting principles and tax calculations. My guess is that they won't get permission to appeal because although that relationship is an important one, it's also, I think, and I say this now with greater confidence, having won the point 3 times, I think that relationship, although conceptually important, is tolerably clear. So let me just pick up the various questions that are sitting in the bottom of my chat function. The first, well, I should see if I can share the screen so that you can see these questions as well. Yeah, no, I'm not sure I can share. Oh, I can. Not sure if that's working or not. Probably isn't. I was trying to share my Zoom screen, which has the questions on it. The first question is a question about, I'll read it to you. It says, in the light of the Court of Appeal decision, please could you comment on whether HMRC's guidance on FRS 102 for income tax and section 5.11 should be revised, and they helpfully give the HMRC text, which says, where a business has entered into a loan on interest-free terms, and this is accounted for under FRS 102 as a financing transaction, the notional interest debited as an expense to the income statement as the loan is returned back to its face value over the period to maturity isn't an allowable deduction for tax, as there is no outlay, no expense has been incurred for the purposes of the business. And they cite section 34 of Toya. I mean, if what the revenue is saying in that guidance is that there is some bar, some obligation not found in a specific statutory adjuration, not to a specific statutory adjustment, as it were, to the accounting code, but in the word incurred, or in some general obligation for there to be an outflow of resources before a debit can be taken in your tax calc, the revenue are, at least for so long as the Court of Appeal decision stands, the revenue are wrong. And the questioner goes on, are there any other areas of HMRC guidance that might also be affected by the decision? I think the answer to that question is there may well be. I haven't reread the guidance in light of the decision. There is a little bit of it, quite a few manuals as I dimly recall. But fundamentally, wherever that point is taken by the revenue, that because there has been no outflow of resources, it follows that whatever the accounting treatment provides, you can't take a gap deduction. The revenue are wrong so to do. I'm just looking to see whether I have any other questions. I've got a question. I won't name the questioner. It's somebody at HMRC who says, in cases where the option was exercised and shares were issued or transferred to the employee, did the company also get a deduction under Part 12 of CTA 2009, relief for employee options to acquire shares? And the answer to that question is yes. So there was, for a brief period of time, a disjunction between the accounting code and the tax code. So there was a specific statutory debit on the grant of shares to an employee, if I recall correctly, whether pursuant to the exercise of a share option or otherwise. The draftsman in those circumstances said, well, you can have a debit. And the debit, the statutory debit, subsisted briefly at least in a world in which there was also the accounting debit for which I was contending. And indeed, before the first tier tribunal and the upper tribunal, the revenue said, well, look, there is this specific statutory regime that gives a debit on the exercise of a share option. It must follow from that that you can't also have a debit on the grant of the share option. To which I said, well, the fact that the draftsman has introduced a statutory debit based on an erroneous predicate that you don't get a debit on the grant of a share option doesn't have as its consequence that you must, judge, do violence to the carefully constructed statutory architecture governing the relationship between the accounting treatment and the statutory adjustments to that accounting treatment. And ultimately, as we know, the statutory scheme was adjusted so that possibility of what one might very broadly describe as a double deduction was removed. So that's the question from the revenue. That point certainly was taken below, was abandoned in the Court of Appeal, and so can't be revived if the revenue get permission to go to the Supreme Court. The individual who asked me that question, I'm now pleased I didn't name him, has said in the Q&A box, I'm not at HMRC, triple exclamation mark. I left HMRC in 2014. I'm showing my age, I'm afraid. I certainly meant it as a compliment rather than as an insult. I have another question, which is, do you think that the profit in Eastern Power from the transfer of a loan relationship for which there was no gap profit and no accounting credit and was judged to exit by the Court of Appeal remains a safe conclusion, i.e. that a non-accounting based credit was required to be created to fairly represent a non-gap profit? The application of the principle in NCL and Smith and Williamson to specific bits of the statutory code isn't one that I can sensibly opine on. I mean, as many of you will know, there is the general world in which the draftsman has said the tax outcome is a function of the generally accepted accounting practice, and then there are some specific exceptions. Then there's another world in which in particular areas, loan relationships, for example, what the draftsman has done is introduce a sort of tax safety net, if you like. So the draftsman has said the tax treatment of this loan relationship is a function, firstly, of the accounting treatment. Secondly, there are these specific statutory exceptions or adjustments. And then thirdly, the draftsman says, but if the accounting treatment is a funny accounting treatment, and funny is my paraphrasing of the phrase that the draftsman typically uses, which is fairly represent. If the tax treatment is funny and doesn't really represent what the real transaction is, you tax on the basis of the real transaction. And there have been a number of recent cases about that fairly represent language. I don't think this case casts any light on what those words fairly represent mean, but where you do have that fairly represent safety net for HMRC or the general body of taxpayers, depending on how you want to describe the person or people for whom that safety net exists, it's not removed by the Smith and Williamson decision. I'm not seeing any more questions. Let me just turn on. If anyone wants to turn on cameras or microphones now, we've enabled you to do that. I can see for the first time whether any of you found any of my jokes amusing. I hadn't quite appreciated when I set off that I wasn't going to be able to see how those quips were landing. So do join if you want. If you don't want to join now, Next week, Rebecca Murray and Sam Way are going to be talking about the transfer of assets abroad regime, and we would be very grateful if you could join us then. Thank you very much, everybody. Please stay safe and well, and it's been nice to see you all.